Since 1934, Iowa's farmers have turned to the Iowa Farm Bureau spokesman as their trusted news source. Now, the Spokesman Speaks. Listen in and hear from leading experts on topics important to farmers and agriculture. Now, here's your host.
Welcome to our January 29th edition of the Spokesman Speaks podcast. I'm Andrew Wheeler, and today's episode will give you a taste of what you can expect to learn through Iowa Farm Bureau's upcoming Ag Market Outlook meeting series. Iowa Farm Bureau's Farmer Education Program Manager, Zach Brummer, and economist, Dr. Christopher Pudenz, join the podcast to share their thoughts on current crop and livestock market conditions and forecast what farmers can expect later in the year. Zach and Christopher will be leading that Ag Market Outlook meeting series, and during those meetings, they'll spend a couple of hours dissecting various market conditions and answering farmers' questions at several locations across the state. For an abbreviated version of that discussion, here's Spokesman Editor Tom Block with Farm Bureau's Dr. Christopher Pudenz and Zach Brummer.
Zach and Christopher, thanks for taking time to sit down with us and talk about the Ag Market Outlook for 2024. Certainly, there's no shortage of things going on and pressures that farmers are facing. To start things off, what are some of the major economic factors affecting farmers this year?
You know, as I sit back and think about this question, I think obviously higher borrowing costs are kind of the biggest thing that I think about beyond not only the ag economy, but just the broader economy in general. But what that results in is producers are paying a lot more attention and having a higher scrutiny in terms of how they allocate their dollars in the upcoming year. I think that's evident in the slowdown in land value increases despite tight supplies that we saw recently. It was a 3.7, I believe, increase in 2023. And when you compare that to 2022 at 17% and 2021 at 29%, I think you can really just see the producer tightening the wallet a little bit in terms of what he's willing to go out there and spend his or her money on. Likewise, I think, you can also see that in the machinery market as well. John Deere's CFO commented here in November that Deere had experienced industry demand weaken much faster than expected in the second half of 2023. And so it's just a really broad kind of transition, in my opinion, in producer behavior when it comes to, again, how they're locating their funds and their appetite for spending money in this environment.
Turning to the international situation a little bit, there are several simmering situations that could create serious logistical bottlenecks here in 2024. The Panama Canal has experienced a long and severe drought that has already led to restrictions on ships passing through the canal, and we're just at the onset of their dry season for this year. And this is a critical route for a lot of trade both in and out of the United States. There's also the Red Sea situation. There's been that series of attacks on shipping vessels that prompted a response by U.S. and Western allies. And it's really anybody's guess regarding what happens next on that major shipping route. And then, kind of hard to believe that I'm saying this, but on the back burner at this point is the ongoing war in Ukraine that has seriously reduced Ukraine's ability to both produce and export crops such as corn and wheat on the world marketplace. So plenty to keep an eye on here in 2024.
One other thing that I'd throw in there is as we approach 2024, from a tax perspective, depending on your risk appetite, unpriced grain, unsold grain that's just sitting in your bin could be converted to cash and put into some sort of, money market fund that's paying 5.25% or better versus losing out on that opportunity. Again, in this inflation environment with things going on, putting that cash to work for you is something that you need to be considering. And we're going to talk about a little more here coming up, but the grain market trajectory as we've entered the year hasn't been favorable either. And so you've kind of got two factors working against you potentially if you're just sitting on grain. This year especially might be worth considering some alternative actions.
Yeah, there's a lot of different homes for that money now as in the past when the interest rates were low. Not many alternative investments, but certainly farmers have a lot more options. But let's dig a little more into those crop market budgets for the 2024 season. The USDA's latest balance sheets showed increased commodity supplies in the U.S. and globally. What does that mean for corn and soybean prices going forward and the effect on crop margins as we take into account things, as you mentioned, input cost, fertilizer, land, things like that?
Yeah, the January WASDE increased the yield kind of surprisingly 2.4 bushels per acre, and that was above trade estimates going in. And it kind of just goes back to this awkward year that we had where, much of the state, much of the Corn Belt, I should say, was in a significant drought, yet yields managed to outperform a lot of industry expectations throughout the growing season. I think that's due, we caught some pretty timely rains early in the season before it turned dry later in the summer, which really helped us out. But when I look at corn, the thing that I'm concerned about is this 2.162 billion bushel carryout that the USDA is projecting. And so there's a lot of noise out there that you can focus on, but I like to think about it as kind of taking inventory, like at a store, basically. It's a supply and demand piece. And so the carryout is essentially telling you what your inventory is at the end of the year. And so historically, when we get above 2 billion bushels for that corn carryout, we see a lot of price pressure. If you go back, if you remember the 2012 drought, which I'm sure everybody does, we had prices skyrocket. But if you go look at the May WASD releases, which is when we get the first look at the upcoming year's balance sheets, if you go look at those in 2012 and 2013, you'll see a significant increase in the projected carryouts the following year, which resulted in significant downward price pressure in the markets. And so for me, we saw it here this most recent May, and I'm anticipating that we're potentially going to see that again coming up here in a few months. We've heard some reports out there, 2.4, 2.6 billion, which would be record carryouts for the 24-25 crop year. If you get that type of number, I think that it's going to be extremely difficult to find some support on the price side. Additionally, you've got traders out in the market, the managed money crowd at 52-week record short positions in both corn and soybeans. And so again, the money's kind of pushing us lower there as well. So something to keep an eye on in that regard.
Zach, another thing you've talked about in your column in the Spokesman Weekly is that corn-soybean price ratio. Do you expect with these downward prices any major acreage shifts based on that corn-soybean price ratio, or even in the fringe acres, maybe the Dakotas are down south, where some of these acres might not go into corn or beans?
So on the bean side from the WASD, you had a 0.7 bushel increase, not even a full bushel, but the carryout increased about 12.5% to 280 million, which historically isn't significantly low, but is still kind of what I would consider a tight U.S. carryout situation. When you contrast that to the world carryout position, the world's got a much stronger balance sheet in terms of what the soy complex looks like. And so that's going to be kind of our struggle on the soybean side, in my opinion. Much more favorable soybeans than I am corn going forward. But you've got China over there currently with a little bit of a hog issue in terms of their soybean demand based on lower hog inventory. And you've got South America with Brazil kind of crawling out of some early weather fears. South America is still projected to be a record soybean crop. And so we're going to be competing with that on the export side. I just don't think we're going to have very much export support in the upcoming year. And so from that perspective, going back to your original question, that corn-soy ratio is currently at 2.51. The 30-year average is 2.48. For me, that's a pretty neutral sign right now that the market's not willing to suggest or incentivize a spread in acreage away from corn into soybeans. Now, when you add in some of the input cost differences, higher input costs on corn to soybeans, that might make that look a little more attractive this year. But if you look at this past summer, we reached 2.86 for comparison. And that's on the DEES 24 and the NOVE 24 corn-soy ratio. And so the higher ratio favors beans. My opinion is that we're going to need to see that ratio do a little work to incentivize some higher bean acres as we move forward. But we're just not seeing that right now. And again, I think a big part of that's the market paying attention to the South American crop and trying to get a better feel for what that looks like.
Turning to the livestock side, cattle producers have seen a large drop in fed cattle prices in the past few months. Why is that happening, Christopher, and what's the outlook for the rest of the year?
You're right. Live cattle futures just completely collapsed this fall. Looking at the April CME contract, prices nearly broke $200 a hundredweight on the board in mid-September. But after that, a series of cattle on feed reports that showed more cattle placements than industry expected precipitated nearly a $35 a hundredweight drop in that contract, all the way down to nearly $165 a hundredweight. There has been a little bit of recovery since then. That April contract is trading about $175 on the board. And there have been some bullish signs lately, especially in terms of, relative length moving averages, with some of those shorter term moving averages inching above your longer term moving averages, which traders take to be as a bullish sign. I think what's happening right now is that the market is slowly realizing that despite there being more cattle on feed placements in those fall reports than the market was expecting, the cattle fundamentals are still the same that they were last summer. We are still going to be tight on feeder cattle supplies, which leads to tight fat cattle supplies several months later on into this year, probably into the next. So the fundamentals do point to us potentially having a little bit of a run here price-wise this spring and into the summer. Something to watch carefully is the net positions of the managed money, exactly like Zach was talking about in terms of grains. Right now, for live cattle, the managed money positions are still net long, but barely. And it's the fewest number of net long positions that we've seen since the summer of 2022. So if that number starts ticking up, it's a good sign that we could be in for that run that I mentioned here that could potentially take place going on into the spring and summer. But remember, cattle feeders, you got to keep your eye on the ball because it's your margin that matters, not necessarily the price. So know your costs and make sure that if you're placing cattle, there is some margin in those cattle.
Hog producers endured a pretty tough year overall in 2023 with losses among the worst on record. What does the forecast look like in the hog sector for 2024?
Unfortunately, 2023 ranks up there with 1998 as one of the worst years on record for hog returns. And it hit everybody in the industry, from the hog feeding folks to the hog breeders. It was just a really tough year. The first couple months of 2024 could similarly be a little rough, but there does finally seem to be a light at the end of the tunnel with some Iowa Farm Bureau forecasting that's built off an Iowa State estimated returns model. But that forecasting takes lean hog futures into account along with some feed futures. And on average in Iowa, farrow to finish hog producers could start making a little money again as soon as April. Now, this is a model. It's for an average producer. But this is good news for an industry that desperately needs to catch a break.
Zach, we'll bounce back to you. Christopher talked about watching that margin. What are some strategies that farmers can use to manage risks for crop production?
I think it goes back to the first question a little bit in terms of where I discussed the producers being a little tighter with their dollars and their decision-making in this upcoming year. And so my recommendation would be to spend some extra time with your crop insurance agent this year. Make sure you have the coverage that you need at appropriate levels while managing your premiums. In addition to that, I just do a little plug. We have a crop insurance webinar February 6th covering enhanced coverage option, ECO, and supplemental coverage option, SCO. I'd suggest tuning into that or catching the recording after the fact to learn more about those add-ons. But again, just to kind of put a bow on that, managing your cash flow is going to be a little more work this year, perhaps, than it has been with the recent profitability we've seen in recent years.
So take advantage of some of those tools that are out there. Christopher, same question to you on the livestock side.
There are the standard tools, that have been around for decades, hedging with futures, hedging with options. Something that I also want to mention is LRP insurance, or livestock revenue protection insurance. And it's a strategy that has gained a lot of traction recently. There's been a increase in uptake of that particular insurance following an increase in the subsidy that is provided for folks purchasing that insurance. You can talk to your crop insurance agent. When you're having that conversation with them that Zach suggested, make sure to talk to your crop insurance agent to see if they also have somebody who sells this LRP livestock insurance. At the end of the day, it ends up being essentially a subsidized put option where you get to cover some of your downside price risk in a way that the cost of doing that is partially subsidized. So it's a great, simple tool, very flexible. Recommend considering using that risk management strategy on the price side if you're thinking about placing cattle or hogs this year.
With that in mind, to manage the margins, and Zach, you mentioned a webinar you have coming up, but Iowa Farm Bureau is also hosting a series of in-person ag market outlook meetings coming up in February. Tell us a little bit about those meetings and what farmers can expect to learn at them.
Yeah, it's going to be somewhat similar to this podcast in terms of Christopher and I presenting both on livestock markets and grain markets. And we're going to go in depth. Obviously, we'll have some slides and things like that and a good discussion with attendees there in the mornings. And in the evenings, you can find out where at iowafarmbureau.com. And we do have a meal provided at each of those. So we'd really just ask for you to take a look. And if one of those fits into your schedule, please do come. They're free to members. And if you're a non-member and interested, just call your county farm bureau and they'll be able to set you up.
Well, thanks for your time, gentlemen. Any parting thoughts for our members as they pencil out their budgets for 2024?
I would just suggest that if we continue to see grain prices move lower, which I anticipate will be the case, I would just suggest getting in front of your landlords, those of you that are renting properties, keeping an open dialogue with them about your profitability, what things look like, and maybe having a conversation about what cash rents are looking like. And obviously with tighter margins this year, staying in front of your bank, keeping an open line of communication with them also is going to be critical just to ensure the success of your operation through maybe a little bit more of a challenging year ahead.
That's one thing we've always talked to farmers in the past. Bankers want to help. There are people out there who want to help, but you just have to be open and have that conversation.
That's exactly correct. The piece of advice that I'd chime in with is really lean into your team this year. Your crop insurance agent, your livestock insurance provider, your risk management advisor, your banker. Like really lean into working with them this year as you manage tighter margins, you manage higher costs of borrowing, things like that. They're there to help you and a quick phone call away.
Thanks, guys. Remember, that interview was just a high-level preview of the analysis you will receive by attending Iowa Farm Bureau's Ag Market Outlook meeting series. That series is free for Iowa Farm Bureau members to attend at locations across the state starting in early February. To learn more and get registered, click the link down in the notes for this podcast episode or head out to iowafarmbureau.com. That's all for this episode of the Spokesman Speaks podcast. We hope you found it insightful and that you'll join us for our next episode on February 12th. Thank you for doing the work that inspires everything we do here at the Iowa Farm Bureau, and thanks for listening to the Spokesman Speaks.
Thank you for listening to the Spokesman Speaks, a podcast by Iowa Farm Bureau. Check out more podcast episodes at iowafarmbureau.com/podcast. You can also find and subscribe to the Spokesman Speaks podcast in the Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, and other popular podcast apps. We appreciate your ratings and reviews, and we welcome you to email us your feedback at podcast@ifbf.org.